In this video, we'll be talking about one of the easiest ways to generate income by selling cash-secured puts. So selling cash-secured puts is an options trading strategy where you play as the bank, selling put option contracts to traders while collecting a premium for your troubles. It is one of the easiest options trading strategies while offering a consistent return. The main downside is that if the stock price drops below the strike price of your options contract, you would have to fill the contract and purchase 100 shares of the company. This is a good strategy if you think that the share price is going to trade sideways and you just want to collect some premium, or if you think the price is going to go up in the long term, but you want to get the stock at a cheaper price. Let's use a hypothetical example to illustrate how this all works. Let's say you have Google stock that's worth $100. And you are selling cash secure puts at a $90 strike price, with an expiry date 1 month from now with a premium of $5 per share. At the expiry date, two potential things can happen. In the first scenario, Google stays above the $90 mark, and it doesn't matter if the price goes up or chops around the range. You will collect the premium of $500 because $5 for each premium and each contract option controls 100 shares. In scenario 2, the price of Google drops down to $80. And in this situation, you'll get assigned to buy 100 Google shares at $90 per share because that is your strike price. But in this situation, you'll also get your $500 premium back, which lowers the average cost of the stock. So instead of spending $90 per share, you're spending $90 minus the $5 premium for the share, which effectively means that you're spending $85 to buy the 100 shares. Let's now use a real example to illustrate how this all works. Now, to start off, you need to pick a good company that you think will go up in the long term that you don't mind holding 100 shares of. Now, this is the most important step in this whole process because stock prices can drop and will drop, and you may end up having to fill the option contract and end up with 100 shares of the company. So you really want to look for a company that you're happy to hold on to. Here in the Tiger Brokers trading app, let's start by picking a good company. For this example, I'll be picking AMD because I believe AMD is a good company to be holding for the long term. Next thing that we want to do is to go to the options menu and make sure that it's on tabbed instead of list. And then we want to pick a time frame. So for most traders looking to buy put options around the 30 to 40 day period, so you want to sell cash secured puts for around that time frame. So in this situation, I'm going to pick the 32-day expiry time frame. The next thing that we're going to do is to pick a strike price. So the strike price are listed down the middle, and we're looking to sell puts, so we're going to be looking at the right-hand side of the columns. The first thing that we want to do here is that we want to look for a delta value of around 0.3. Now, without going into too complicated details, delta refers to the probability of the option being in money at the expiry date. So a 0.3 delta is 30%, so a 30% chance of it being in the money. If we want to collect the premium for selling the cash secured puts, or we want the contract to actually be out of the money at the expiry date, as opposed to being in the money. So a delta of 0.3 means a 30% chance roughly of being in the money. So a 70% chance of the contract being out of money. This means that there's a 70% chance of you collecting the premium at expiry. Now, if you are a little bit less risk tolerant, you can go for a lower strike price if you want to be safer. So I can select the $55 strike price, and it's got a delta of 0.24. A lower strike price in this instance means that you'll be receiving less premium, but you'll end up more likely to be receiving the premium. So it really depends on your risk tolerance. In this example, we're going to be selling a put option with a strike price of $55, and each contract has a premium of $1.9 per share. If we bring up the advanced menu, we can specify the quantity that we want. So let's say, for example, we want just one contract for this. So the maximum profit is $190, which is 100 times the premium for one share. Our max loss occurs when the stock price drops below the strike price, which means that we have to buy 100 shares, which would have cost $55 times 100, which is $5,500. But we will also get our premium back, which is $190. That's how we end up with the $5,310. So basically, if everything goes according to plan and the contract expires out of the money, we will just collect the $190. So why do we even want to use cash-secured puts? Now, it seems like we're not actually gaining that much when we're only getting $190 from putting out $5,500. But if we divide 190 over 5,500, we can see that we are getting around a 3.5% return every 30 to 40 days. Now, if we can do that for around 12 times per year, we end up getting around 40% returns. Obviously, the numbers can fluctuate a bit, but you'll still end up getting quite a significant amount of returns. Secondly, you can treat cash-secured puts as an alternative to using limit buy. Now, in this situation, you are basically picking the strike price as your limit buy price that you are willing to purchase the shares at. Now, the main difference here is that you would end up needing to purchase 100 shares. This leads us to the downside of using cash-secured puts. First off, you need to have the money to purchase 100 shares of the company. Sometimes shares of the companies can be quite expensive. So if the shares of the company that you want to sell the puts for cost $300, 100 shares would cost $30,000. And that's a pretty decent size of money that maybe a lot of people won't have. Secondly, if the price of the stock drops significantly and your order end up getting filled, you may have to hold on to the stock for a considerable amount of time. Again, this is why it's so important that you choose a stock that you don't mind holding onto for the long term, just in case the prices do drop. But overall, cash-secure puts is a very easy way to generate some income when the stock is trading sideways, and you can easily do that with Tiger Brokers. Now use the link in the description below to sign up and receive some free bonus gifts. And also check out this next video if you are interested in learning more about options trading.